Financial Meltdown of 2008, A Fundamentals Approach, by Bernard C. Beaudreau, Professor of Economics, Laval University, Quebec City, Canada. What caused the financial meltdown of 2008? What caused the worst financial crisis in history? Was it financial deregulation? Or was it Wall Street greed? Could Fannie Mae, Freddie Mac, have somehow been involved? To most observers, the combination of financial deregulation, Wall Street greed, and GSE largesse combined to produce what is by far the worst financial crisis in American history. A crisis that brought the financial system to its knees. But was this the case? Was financial deregulation the true cause? As CSI investigators know only too well, the obvious is oftentimes misleading. In this particular case, we have to ask the following question. Was financial deregulation the true cause? Was it the precipitating factor? In the Financial Meltdown of 2008, The Fundamentals Approach, Laval University economics professor Bernard C. Beaudreau rejects this view, arguing that financial deregulation was not the cause, but rather was a consequence of the true underlying cause, namely underincome, which itself was the result of two structural changes, namely factory automation and outsourcing. Underincome, Beaudreau explains, refers to the disequilibrium between potential output and the level of income and expenditure in the economy at any one point in time. His line of reasoning runs as follows. The past 3 decades witnessed two important structural changes in the West, namely factory automation and outsourcing. Both combined to lower the ratio of wage income to overall income. Firms that replaced workers with control devices lowered their variable costs, as did those who outsourced their activities to low-wage countries. While these strategies were very profitable for the firms, they were catastrophic for the economy as a whole, as they reduced purchasing power. As profits are a residual form of income, it stands to reason that throughout this period, income and expenditure waned. Product markets suffered as a result. This raised a fundamental policy issue, namely how to address this problem. With the death of Keynesian economics came a new set of challenges. For example, the Reagan administration could not turn to fiscal policy to stimulate product markets in the early 80s, nor could it turn to monetary policy, as it had chosen high interest rates as a means to deal with the high levels of inflation. In short, it found itself in a policy bind. What was it to do? As it turned out, it chose financial innovation, aimed at providing Americans with easier access to household credit, mortgage credit, and consumer credit. And so began a series of policy measures aimed at increasing household debt, and consequently increasing overall consumer spending. Ironically, as consumers' abilities to assume debt was on the wane owing to falling real wages, they were being called upon to bolster sagging U.S. and indeed world product markets. Among the key policy measures were 1. The Garn-Saint-Germain Depository Institutions Act of 1982 and the Secondary Mortgage Market Enhancement Act of 1984, and lastly, the Graham-Bliley-Leach Act of 1999. The result? Household credit, defined as the sum of mortgage and consumer credit, soared in the U.S. economy. As a result, U.S. and world product markets gained strength. In fact, the results were better than expected. The housing boom generated unexpected gains, as homeowner net wealth soared. Banks responded by offering a new product, home equity loans, which provided an unexpected stimulus. The key to Beaudreau's argument is the issue of sustainability. With the wage share on the wane, household credit financed expenditure became a staple in the United States and indeed throughout the West. The problem is that it wasn't sustainable. For a quarter of a century, household credit soared on the strength of housing prices. Clearly, this could not continue forever. When the bubble burst, the house of cards came tumbling down. Seen in this light, the financial meltdown of 2008 was ultimately caused by fundamentals, specifically structural change that ushered in misguided and misconceived of policy, not to mention unsustainable policy measures. With factory automation and outsourcing, America and indeed the world economy is less and less able to take the goods they produce off of the market. This explains the growing importance of household credit in all Western industrialized economies. For more on this, get The Financial Meltdown of 2008, a Fundamentals Approach by Bernard C. Beaudreau, available at all good booksellers and Amazon.com.